The expert Wall Street is making a 9-year of the bull. It is the second longest streak since World War II, and many people are wondering when it will all come to an end.
That's why we have local financial professional Brad Allen from wealthwisconsin.com joins us now live to talk about what we should consider with our own money. So when we're talking about the bull, we're talking about a bull running, and the numbers have been going up.
Right. So bull market means market's rising.
Yeah.
And it has
That's a
been
good thing.
since March of 2009, since the S&P bottomed out.
It's good until it doesn't.
Yeah. The stocks have gone up 300% since then.
Wow.
Okay.
Right. So it's been a little volatile here recently.
Yeah.
But the market has not gone down 20%, which would make it a bear market.
Okay.
And the term bull and bear comes from, a bull is pushing its horns up, and a bear is swiping its paw down. So that's where it came from.
Okay.
All right,
What should I do? What should I do with my 401k? Should I worry? Should I not?
Yeah, I mean, you want to put together a plan. Whether you're young or you're old, you want to take a look at what is your age. The younger you are, the longer you have to invest, and the more aggressive you can be. So if the market all of a sudden takes a tumble, you're not going to be as worried about it because you have the time to make it back up.
So you're asking me to have a lot of faith.
That's right. Yeah. Over time, it's going to go back up. So age really does matter, though, because
Faith and patience.
Right.
Right.
But
if you don't like to lose money, you've got to be careful on what kind of aggressiveness you're going to be, right?
You have to see what is your risk tolerance.
Yeah.
And that goes down the closer you get to retirement. The more you should start to pull back on the risk a little bit because you give up that time, right? You don't have the time to make it back. If you're going to retire next year and the market goes down 40%, and you have to keep working after that. So you just want to be careful about how much risk you're taking on.
So if you're in your 20s versus if you're in your 50s, you've got to have a different strategy.
Sure.
Right. You can be as aggressive as you want in your 20s, if it's in line with your goals.
Exactly.
Right?
Yeah.
And then once you get to retirement, you want to have a plan on how to take that money out. So let's say you need a 5% withdrawal to keep up with your expenses per year. But if you're invested at a 12% or 15%, you're taking unnecessary risk, right? Because if the market goes down, you're more aggressive than where you need to be at that time. So you just have to be careful with how aggressive you are.
And the other thing is that when you have that one day where it goes down 10%, 15%.
Don't panic.
Right.
Don't panic.
That emotional investing. Stick with it. It's the folks who stuck with it and kept putting money in.
9 years.
Tripled their investment over that time.
It's hard to time the market, as they say. All right. But good timing on your part to be here today.